Welcome back. This morning, the non-farm payrolls were reported to have risen by 150,000. That's less than market expectations. The unemployment rose to 3.9% from the prior 3.8. It was not expected to rise. The question on everyone's mind is, does this qualify as a softening labor market, as foretold by the Federal Reserve meeting just the other day? Non-farm payrolls, we can see over here 150,000 jobs created in the prior month. This is the second lowest low we've seen in a very, very long time, only surpassed by June of this year. Certainly not a good number. Non-farm payroll on a year-over-year basis, so comparing October of this year to October of last year, down 54%. Certainly a deterioration in the labor market. To be sure, unemployment rate rose to 3.9%, which is not good. It was at 3.8. It was not expected to rise. This is now, we can see, just by a small degree, the highest unemployment rate we've seen. It looks like going back to November of 2022. I'm sorry, 2021, or maybe the beginning of 2022. It is not a good thing that this unemployment rate is now at least a 1-year high. And this is, of course, comparing it to the S&P 500, which we can see this is the unemployment rate on a year-over-year basis. It is now improving. Well, not improving, but it is increasing, which is not an improvement. And generally speaking, when unemployment rates go up, as we saw during the COVID crisis, stock markets go down. So, does the current stock market weakness, well, not the past couple of days, but overall, the sell-off we've seen in the past couple of months, does this coincide with the weakening labor markets? Here's the unemployment year over year, comparing this month to this month last year, 5.4%. So the unemployment rate is worse now this time this year than this time last year. And it's important that we use a year over year basis to compare, to take out seasonal factors such as holiday shopping, which certainly can change the labor market. In any case, it is not improving. We see here average hourly earnings of all employees in the private sector, continues to go up. That doesn't really tell us very much, but when we compare this on a year-over-year basis, we can see year over year we've only risen by 4.1%. It's good that it's going up, not good that it's going up at the slowest pace we've seen. This looks like going back to June of 2021. So the average hourly earnings on a year-over-year basis is at the worst position in over a year as well. And again, this has, a positive correlation in the sense that when the stock market, the S&P 500 in this case, goes up, average hourly earnings go up. When average hourly earnings go down, it usually coincides with weak stock prices. Labor force participation rate at 62.7%. That's also a deterioration and also a strong positive correlation. When stocks go up, labor force participation rate goes up. Now, these numbers don't move by large amounts, 62.7 versus 62.8, but it's important to recognize even the smallest changes because it factors in millions and millions of jobs and millions of people within the labor force. Here's the labor force participation rate down 0.8% on a year-over-year basis. It's just slightly better, but we'd like to see, if we see economic growth, we'd like to see some real economic growth. This does not look like that. Here's the unemployment rate on a state average. So every state has their own respective unemployment rate. And then what we do is we take all those states, we put them together, we get the average 3.2%. This is different than the nationally published unemployment rate, but we have the data. So I think it's important to look at this from many different angles. At any rate, it's at 3.2%. It's higher than we've seen in quite a long time, probably going back to June, which coincides with some of the other numbers. It looks like these numbers are in the worst position we've seen since June, and in other cases, the worst position we've seen in 14, 15 months. Now, from the recent Federal Reserve meeting, we spoke about this just the other day. If you're curious, please feel free to take a look. Jerome Powell, Federal Reserve Chairman, said in part, I still believe, and my colleagues for the most part still believe, that it is likely to be true that we will need to see some slower growth and some softening in the labor market to fully restore price stability. That means We've raised interest rates to fight inflation. The Federal Reserve is a dual mandate. One of the objectives is price stability. Price stability is keeping inflation down. Well, they say we want to see some slower growth and some softening in the labor market to fully restore price stability, meaning to get inflation back down and to stop raising rates and to maybe start lowering rates. So does this qualify completely as slower growth and softening in the labor market? Let us know what you think. It certainly is a worse number we've seen in a while. Now, of course, the Federal Reserve has to balance this with inflation. So when the CPI and the PCE and the PPI, the inflation numbers come up better than expected, higher than expected, that kind of ties their hands. But the labor market certainly is softening. Again, 150,000 new jobs created. It's the second worst number we've seen in a very, very long time. And on a year-over-year basis, we're down 54%. It's one of the worst declines we've seen in, again, quite a long time as well. So let us know what you think. What should the Federal Reserve do at this point? Is the labor market softening enough where, maybe they should start to lower interest rates? We're going to take a look at a little bit later on the Federal Reserve Fed funds futures and see what they say about the likely chances of an increase or decrease in interest rates in the next meeting. We hope this has been helpful. We look forward to seeing you back soon.